Hello, everyone. And today, Jim and I would like to talk a little bit about the plans we have going forward for your holdings and for the market and the economy in general. And I want to start by talking about the things that we know for sure. We know that stock valuations are very high. PE ratios are above average. And we know that there is a correction looming at some point in the future. The second thing that we know is that the Federal Reserve has had an extremely accommodative monetary policy. Money is cheap, and the Fed's cheap money policy is like a drug addiction to the markets. We also know that this accommodative policy will eventually end, and likely very soon. We know that the stock market does not like it when the Fed starts taking things away. And we have learned over the past pandemic, financial crisis markets that when the market decides it's going to move, in today's world, that move is extremely fast and often violent. And finally, and most importantly, we know that we've had some very large gains over the past year, and we don't want to lose them. Now, there's one very important thing that we're not quite sure of. We do not know when the correction will come and what the final impetus will be for that correction. So our conclusion is that we need to take some steps now to be prepared for any potential large declines, but also stay allocated in a way to reap gains if the market continues to go upward. So, Jim, well, can you go a little bit into what we have planned going forward?
Sure. Thanks, Jim. So the problem, as Jim described it, is there's sort of a contingent risk out there of this Federal Reserve announcement. And this Federal Reserve announcement is going to sound something like that all this cash they've been pushing out into the economy, which has fueled a rally in almost all asset prices, not just stocks and bonds, but also real estate and commodity prices have risen because of the Federal Reserve actions, which were needed. But we're worried about what happens, as Jim said, when they make an announcement that, oh, we're going to slow down. Now, we know that in 2018, when they made such an announcement, the market fell 20% in just a matter of a few weeks. Now, the thing is, it did recover. It recovered the very next year and with something to spare. But to the extent that we can build some cash now ahead of such an announcement, it may well give us an opportunity to add some investments that are on sale, so to speak. Now, generally speaking, the problem is we like the stocks that we currently own for you. And so rather than pick one here or one there to sell in order to reduce your exposure to the stock market, we're going to be reducing our holdings pro rata over the next few weeks. And we're able to do this because Schwab has a zero commission policy. So we can trade 1 share, 2 shares, 100 shares. It doesn't matter. The cost of those trades is zero. And that comes in handy for this particular strategy. So we're going to be selling some holdings on a pro rata basis, probably not selling out of any one particular holding altogether, unless we think that it's just time to get out of that holding. And then we're going to wait and see what the Fed has to say at their next couple of meetings. And these sales are going to create the cash to take advantage of opportunities that may arise after such an announcement. And again, we're not worried about the federal announcement long term. We're worried about what it would do to portfolio values short term. So making these trades will do 2 things. It will create cash to take advantage of those opportunities, but it will also lighten your exposure to the market so that if we do indeed get a correction, you won't be nearly as exposed. All right, well, you may have noticed there's a third person on your screen. We would like to introduce you to our new associate, Morgan Hood. Morgan joined us at the beginning of June, and Jim and I are very excited to have been able to add someone of her caliber. And so, Morgan, why don't you tell us a little bit about yourself?
Yeah, thanks. So as you said, I am Morgan Hood. I'm a graduate of Kent State University. My degree is in actuarial mathematics. So it's not exactly what I'm doing here, but it's certainly related and has already helped me thus far. I started at the beginning of June. And with that being said, I have met a handful of you, but most of you I have not. I'm very excited to start putting some names with faces. And so if you just want to stop in and say hello, and we can sit down and talk for a little bit just so we can start to get to know each other. I am here to assist Jim and Jim. So whatever I can do to help them, that's what I'll be doing. So I have a lot to learn, but luckily I do have two great teachers. So just like them, I am here to serve you to the best of my ability. If either of them or both of them are not in the office when you stop in or have a call, I will do my best to answer your questions or get you to the resources that you need to answer your question. With what Jim mentioned, with the reducing your shares pro rata, I will probably be the one implementing a lot of those trades under their direction. So if you have any questions regarding the trades, just give us a call and one of us can answer your questions for you.
Okay, thank you, Morgan. And to repeat what Jim said, we are excited about having Morgan as part of our company. And again, not to put too high a pressure on her, but our expectations for her in the months and years ahead are very high.
Yes, they are.
So until our next update, stay healthy, take care of yourself, and feel free to contact us anytime and with any questions or concerns you might have.